Question 1. Which of the following is the primary purpose of facultative reinsurance? A. To automatically cover all policies under a treaty. B. To provide coverage on a specific risk or policy-by-policy basis. C. To provide a proportional share of losses across multiple insurers. D. To manage capital by transferring risk to multiple reinsurers. Answer: B. To provide coverage on a specific risk or policy-by-policy basis. Explanation: facultative reinsurance involves a case-by-case assessment where the ceding insurer seeks reinsurance for a specific policy or risk. Unlike treaty reinsurance, which applies automatic coverage, facultative reinsurance is not prearranged for a group of policies but is negotiated for each individual risk. The reinsurer decides whether to accept or decline coverage on a specific risk after evaluation. This method is particularly useful when the ceding insurer needs to transfer risks outside the scope of their treaty reinsurance. Question 2. In a surplus share reinsurance arrangement, how is the reinsurance premium typically calculated? A. The reinsurer assumes a fixed percentage of the insurer's losses based on defined surplus limit. B. The reinsurer assumes an equal percentage of each policy's losses. C. The ceding insurer transfers fixed percentage of premiums to the reinsurer. D. The reinsurer assumes 100% of losses beyond specific threshold. Answer: A. The reinsurer assumes a fixed percentage of the insurer's losses based on defined surplus limit. Explanation: in surplus share reinsurance arrangement, the reinsurer agrees to cover losses that exceed defined retention limit based on the amount of surplus the ceding insurer retains. The ceding insurer keeps a portion of the premium and risk while the reinsurer covers the excess. The amount of coverage provided by the reinsurer is proportional to the amount of risk the ceding insurer has ceded beyond its retention limit. This approach helps the ceding insurer manage larger losses that exceed their capacity. Question 3. Scenario question. Mr. Taylor is a ceding insurer and has entered into a treaty reinsurance agreement with a reinsurer. During the year, Mr. Taylor experiences several large losses due to a series of weather-related events. Given these events, Mr. Taylor is considering modifying the treaty to better address future catastrophic losses. What should Mr. Taylor do to ensure that future catastrophic risks are effectively managed under the treaty? A. Increase the ceding insurer's retention limit under the treaty. B. Negotiate for a higher proportion of the losses to be covered by the reinsurer under a quota share arrangement. C. Implement an excessive loss reinsurance clause to protect against large individual events. D. Reduce the reinsurer's role in covering large losses and retain more risk. Answer: C. Implement an excessive loss reinsurance clause to protect against large individual events. Explanation: an excessive loss reinsurance clause is designed to protect the ceding insurer from large individual claims or catastrophic events that exceed a certain threshold. This type of reinsurance covers losses that are above the retention limit set by the ceding insurer, which is ideal for managing catastrophic risks. The clause ensures that the insurer is protected from extreme losses that would otherwise destabilize their financial position. Increasing the retention limit, option A, or reducing the reinsurer's role, option D, would expose the ceding insurer to more risk, while quota share, option B, would not be as effective for large, specific losses. Question 4. Which of the following is a key benefit of retrocession in reinsurance? A. It transfers risk from the ceding insurer to the reinsurer. B. It allows the reinsurer to transfer a portion of the risk to another reinsurer. C. It increases the amount of risk a reinsurer retains. D. It automatically covers all policies within the retrocession agreement. Answer: B. It allows the reinsurer to transfer a portion of the risk to another reinsurer. Explanation: retrocession refers to the process in which a reinsurer, the retrocedent, transfers part of the risk it has assumed to another reinsurer, the retrocessionaire. This allows the original reinsurer to manage its own risk exposure by spreading the risk further. It is commonly used to maintain solvency, diversify risk, and manage capacity. Unlike prior reinsurance agreements, retrocession agreements are used by reinsurers, not ceding insurers. Question 5. Which of the following reinsurance contracts is most likely to be used when the ceding insurer wants automatic coverage for all policies within a specified class of business? A. Facultative reinsurance. B. Surplus share reinsurance. C. Treaty reinsurance. D. Excessive loss reinsurance. Answer: C. Treaty reinsurance. Explanation: treaty reinsurance provides automatic coverage for all policies within a specified class of business or risk pool. This type of reinsurance agreement typically covers large portfolios of policies, such as all policies within a certain line of business, e.g., property casualty. Facultative reinsurance option A covers specific policies on a case-by-case basis, and excessive reinsurance option D applies to large individual losses beyond a certain threshold, but treaty reinsurance is the method that provides comprehensive automatic coverage for multiple policies. Question 6. Scenario question. Ms. Roberts is the underwriter at a reinsurance company. She is reviewing a new treaty agreement with a ceding insurer that specializes in coastal property insurance. The ceding insurer wants to ensure that they are protected from catastrophic weather-related events, such as hurricanes. What type of reinsurance agreement would be most appropriate for Ms. Roberts to recommend? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Facultative reinsurance. D. Surplus share reinsurance. Answer: B. Excessive loss reinsurance. Explanation: excessive loss reinsurance is the most appropriate choice for protecting against catastrophic events, such as hurricanes. This type of reinsurance covers losses that exceed a specified retention limit, providing coverage for large unexpected losses. Given the ceding insurer's focus on coastal property insurance, catastrophic event like hurricane could cause large losses, making excessive reinsurance suitable option. Quota share reinsurance option A would provide proportional coverage, but it is typically more useful for ongoing, predictable losses rather than catastrophic events. Facultative reinsurance option C is used for individual policies, not large events, and surplus share reinsurance option D is better suited for managing risk proportional to the amount retained. Question 7. When a ceding insurer transfers a portion of its risk to a reinsurer, which of the following does the reinsurer generally receive in return? A. A premium based on a percentage of the risk ceded. B. A fixed upfront fee for each policy covered. C. Compensation based on the reinsurer's profitability. D. Commission on the premiums collected from the ceding insurer's clients. Answer A. A premium based on a percentage of the risk ceded. Explanation: in reinsurance, the reinsurer typically receives a premium from the ceding insurer based on the amount of risk that is transferred to them. This premium is proportional to the amount of risk the reinsurer assumes under the reinsurance agreement. The premium is calculated based on the type of reinsurance, the risk profile, and the terms of the agreement. Options B, C, and D are incorrect because the reinsurer does not generally receive fixed fees or commissions, but rather premiums based on the transferred risk. Question 8. Which of the following is an example of a non-proportional reinsurance contract? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer: C. Excessive loss reinsurance. Explanation: non-proportional reinsurance contracts, such as excessive loss reinsurance, do not involve the sharing of premiums and losses on a proportional basis. Instead, the reinsurer agrees to cover losses that exceed a specified threshold, and the ceding insurer retains a portion of the losses up to that limit. In contrast, proportional contracts, e.g., quota share and surplus share reinsurance, involve the reinsurer taking on a fixed percentage of the premiums and losses. Facultative reinsurance option D is not a reinsurance type based on the proportional or non-proportional distinction, but instead is a case-by-case arrangement. Question 9. Scenario question. Mr. Anderson, the risk manager at a large insurance company, is tasked with reducing the volatility of claims payouts in the company's portfolio. The company is exposed to high-frequency, low-severity losses, and Mr. Anderson wants to mitigate this risk while maintaining cost efficiency. What type of reinsurance should Mr. Anderson consider? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Stop-loss reinsurance. D. Facultative reinsurance. Answer: C. Stop-loss reinsurance. Explanation: stop-loss reinsurance is a type of non-proportional reinsurance that protects the ceding insurer from cumulative losses that exceed a certain threshold over a specified period. It is an ideal solution for mitigating volatility, especially for high-frequency, low-severity losses. It ensures that if the insurer's losses accumulate to an excessive level, the reinsurer will cover the excessive. Reinsurance, option A, is more appropriate for large individual losses rather than aggregate exposure, and quota share, option B, involves proportional sharing, which might not effectively address the issue of volatility. Facultative reinsurance, option D, is typically used for specific risks, not large portfolios. Question 10. In the context of reinsurance, what is the role of a reinsurer's capital? A. To directly influence the pricing of reinsurance premiums. B. To determine the size of the reinsurance market. C. To ensure that the reinsurer can meet its obligations to ceding insurers. D. To dictate the amount of risk that can be transferred under a treaty. Answer C. To ensure that the reinsurer can meet its obligations to ceding insurers. Explanation. The capital of a reinsurer is essential to ensure its financial solvency and ability to meet its obligations under reinsurance contracts. Adequate capital helps the reinsurer cover claims and losses from ceded risks. It is also a regulatory requirement in many jurisdictions to ensure that reinsurers can handle unexpected events, maintain solvency, and support their liabilities. While capital may influence premium pricing, option A, and risk transfer limits, option D, its primary purpose is to ensure that the reinsurer can meet its contractual obligations, which is for maintaining the stability of the reinsurance market. Question 11. Which of the following is true regarding the National Association of Insurance Commissioners, NAIC, and its influence on reinsurance regulations in Arizona? A. The NAIC has no impact on Arizona's reinsurance regulations. B. The NAIC provides a framework for reinsurance contracts but does not enforce them. C. Arizona's reinsurance regulations are fully aligned with NAIC standards. D. The NAIC regulates the pricing of reinsurance premiums in Arizona. Answer C. Arizona's reinsurance regulations are fully aligned with NAIC standards. Explanation. The NAIC sets guidelines and standards that many states, including Arizona, use as the foundation for their reinsurance regulations. These standards cover areas such as solvency requirements, financial reporting, and reinsurance agreements. While states can adopt and modify certain aspects of the NAIC guidelines, Arizona's reinsurance regulations closely aligned with NAIC standards to ensure uniformity and solvency across the insurance industry. The NAIC does not regulate pricing, option D, or enforce contracts directly, option B, but rather provides framework for states to adopt. Question 12. What is a key distinction between proportional and non-proportional reinsurance? A. Proportional reinsurance is based on fixed premiums, while non-proportional reinsurance is based on variable premiums. B. Proportional reinsurance involves the sharing of both premiums and losses, while non-proportional reinsurance only involves sharing losses. C. Non-proportional reinsurance is applied to smaller risks, while proportional reinsurance covers larger risks. D. Proportional reinsurance involves individual assessments, while non-proportional reinsurance involves automatic coverage. Answer B. Proportional reinsurance involves the sharing of both premiums and losses, while non-proportional reinsurance only involves sharing losses. Explanation. The main distinction between proportional and non-proportional reinsurance lies in how the premiums and losses are shared. In proportional reinsurance, such as quota share and surplus share, both premiums and losses are shared between the ceding insurer and the reinsurer according to a predetermined percentage. Non-proportional reinsurance, like excessive loss reinsurance, involves the reinsurer only covering losses that exceed a certain threshold, and the ceding insurer retains the initial portion of the losses. Question 13. What is the primary objective of surplus share reinsurance? A. To provide coverage for large catastrophic losses. B. To share a fixed percentage of premiums and losses. C. To cover individual high-risk policies. D. To transfer risk from the ceding insurer to the reinsurer in a proportional manner. Answer B. To share a fixed percentage of premiums and losses. Explanation. Surplus share reinsurance is a type of proportional reinsurance where the reinsurer assumes a fixed percentage of premiums and losses above a certain retention limit. This is often used when the ceding insurer has a policy with a risk that exceeds its retention capacity. The reinsurer agrees to cover losses that exceed the retention limit, and in return they receive a proportional per the premium. Question 14, scenario question. In a treaty reinsurance agreement, the ceding insurer agrees to cover 60% of the premiums and losses for policies within a specific class of business, while the reinsurer covers the remaining 40%. What type of reinsurance is this? A. Surplus share reinsurance. B. Quota share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer B. Quota share reinsurance. Explanation: quota share reinsurance is a proportional reinsurance agreement where both the ceding insurer and the reinsurer share a fixed percentage of premiums and losses. In this case, the ceding insurer retains 60% and cedes 40% of the risk to the reinsurer, which is characteristic of a quota share arrangement. Surplus share option A involves sharing premiums and losses above retention, while excessive loss option C covers losses exceeding a specified threshold. Question 15. Which of the following is an example of an event that would most likely trigger an excessive loss reinsurance agreement? A. A minor fire loss within a policyholder's property. B. Large earthquake causing widespread damage. C. Series of small claims from multiple policyholders. D. Flood that impacts several local regions. Answer B. A large earthquake causing widespread damage. Explanation: excessive loss reinsurance is designed to cover large, catastrophic losses that exceed a certain threshold. In this case, a large earthquake causing widespread damage would likely trigger an excessive loss reinsurance agreement. This type of reinsurance is typically used for catastrophic events such as natural disasters that result in large claims. Minor losses, option A, and frequent claims, option C, are typically not covered by excessive loss reinsurance. Question 16. What does a retrocession agreement allow a reinsurer to do? A. Transfer risks back to the original insurer. B. Pass on risk to another reinsurer. C. Offer primary insurance coverage. D. Modify the terms of a reinsurance contract. Answer B. Pass on risk to another reinsurer. Explanation: retrocession is the process by which a reinsurer transfers part of its risk to another reinsurer. This is typically done to manage exposure to high risks, maintain solvency, and diversify their portfolio. Retrocession allows the reinsurer, the retrocedent, to offload risk to another reinsurer, the retrocessionaire, but it does not involve transferring the risk back to the primary in option A. Question 17. What type of reinsurance is generally applied when the ceding insurer wants to cover only high severity, low frequency losses? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Facultative reinsurance. D. Treaty reinsurance. Answer B. Excessive loss reinsurance. Explanation: excessive loss reinsurance is designed for situations where the ceding insurer wants to cover high severity, low frequency losses. This type of reinsurance protects the insurer from catastrophic events, such as large individual losses that exceed a specific threshold. It does not apply to frequent, smaller losses, making it ideal for covering rare but severe risks. Question 18. Scenario question. An insurance company has ceded its policies to a reinsurer under a treaty reinsurance agreement. The reinsurer agrees to cover 80% of losses above a retention limit of $1 million, while the ceding insurer retains 20%. What is the total amount the reinsurer will pay if the company faces a $3 million claim? A. $1 million. B. $2 million. C. $2.4 million. D. $3 million. Answer B. $2 million. Explanation: under this treaty reinsurance agreement, the reinsurer will cover 80% of the losses above the $1 million retention limit. The total claim is $3 million and the retention limit is $1 million. Therefore, the reinsurer will cover 80% of the remaining $2 million, $3 million, $1 million, which equals $2 million. The ceding insurer retains the $1 million of the loss. Question 19. Which of the following statements best describes facultative reinsurance? A. It is a reinsurance arrangement where risks are transferred automatically under a contract. B. It involves the ceding insurer offering individual risks to the reinsurer for evaluation. C. It is used to cover a large pool of risks on a proportional basis. D. It automatically adjusts to cover losses exceeding a predetermined threshold. Answer B. It involves the ceding insurer offering individual risks to the reinsurer for evaluation. Explanation: facultative reinsurance involves the ceding insurer offering individual risks to the reinsurer for evaluation and acceptance. Unlike treaty reinsurance, which automatically covers a pool of risks, facultative reinsurance is negotiated on a case-by-case basis. The reinsurer can accept or reject the risk and typically used for large or unusual risks. Question 20. Scenario question. An insurance company has purchased a quota share reinsurance agreement with a reinsurer. If the ceding insurer collects $10 million in premiums and the quota share agreement specifies a 40% cession, how much of the premium will the reinsurer receive? A. $4 million. B. $6 million. C. $10 million. D. $2 million. Answer A. $4 million. Explanation. In a quota share reinsurance agreement, the reinsurer receives a fixed percentage of the premiums and losses. Since the cession is 40% in this scenario, the reinsurer will receive 40% of the $10 million in premiums, which is $4 million. Question 21. What is the main advantage of using retrocession for a reinsurer? A. To cover small, frequent losses. B. To reduce risk exposure by passing on part of the risk to another reinsurer. C. To enhance profitability by increasing the number of policies. D. To eliminate all risk from the reinsurer's portfolio. Answer B. To reduce risk exposure by passing on part of the risk to another reinsurer. Explanation. The main advantage of retrocession is that it allows a reinsurer to pass on part of its risk to another reinsurer. This helps reduce the reinsurer's overall exposure, manage its capital requirements, and maintain solvency. Retrocession does not eliminate all risk, option D, but instead spreads the risk further within the reinsurance industry. Question 22. What type of reinsurance is used when the ceding insurer wants to transfer only specific high-risk policies on a case-by-case basis? A. Quota share reinsurance. B. Surplus share reinsurance. C. Facultative reinsurance. D. Excessive loss reinsurance. Answer C. Facultative reinsurance. Explanation. Facultative reinsurance is used when the ceding insurer wants to transfer specific high-risk policies on a case-by-case basis. The reinsurer evaluates and accepts or rejects individual risks, making it flexible and suitable for unusual or large risks. Question 23. Scenario question. A reinsurer has agreed to provide excessive loss coverage for a ceding insurer. The ceding insurer has a retention of $500,000 and the reinsurer covers 90% of losses above this amount. If the ceding insurer faces a $1.5 million loss, how much will the reinsurer pay? A. $900,000. B. $1 million. C. $450,000. D. $1.5 million. Answer A. $900,000. Explanation. The ceding insurer retains the first $500,000 of the loss. The remaining loss is $1 million, $1.5 million, $500,000, and the reinsurer covers 90% of this amount, which equals $900,000, $1 million x 90%. Question 24. Which of the following statements is true regarding the NAIC's role in reinsurance? A. The NAIC sets the prices for reinsurance premiums. B. The NAIC enforces reinsurance contracts between ceding insurers and reinsurers. C. The NAIC provides guidelines for state-level regulation of reinsurance. D. The NAIC mandates the use of retrocession in all reinsurance agreements. Answer C. The NAIC provides guidelines for state-level regulation of reinsurance. Explanation. The NAIC, National Association of Insurance Commissioners, provides guidelines and model laws that states can adopt to regulate the reinsurance industry. The NAIC does not set prices for premiums, option A, or enforce contracts, option B, nor does it mandate the use of retrocession, option D. Instead, it offers a framework for states to ensure that reinsurers operate within appropriate regulatory standards. Question 25. What is a key disadvantage of facultative reinsurance for a ceding insurer? A. It requires the ceding insurer to accept all reinsurer terms. B. It provides automatic coverage for large pools of risks. C. It may require the ceding insurer to negotiate each individual risk. D. It may involve high retention limits. Answer C. It may require the ceding insurer to negotiate each individual risk. Explanation. Facultative reinsurance requires the ceding insurer to negotiate each individual risk with the reinsurer, which can be time-consuming and complex. This is a disadvantage compared to treaty reinsurance, which provides automatic coverage for large pools of risks. Question 26. Scenario question. A reinsurer covers 70% of losses above a retention limit of $200,000. If the ceding insurer faces a $500,000 loss, how much will the reinsurer pay? A. $210,000. B. $300,000. C. $350,000. D. $500,000. Answer C. $350,000. Explanation: the retention limit is $200,000, so the reinsurer covers losses above that amount. The total loss is $500,000, leaving $300,000 above the retention. Since the reinsurer covers 70% of that amount, they will pay $350,000. $300,000 x 70%. Question 27. What is the primary benefit of using quota share reinsurance for? A ceding insurer. A. It provides protection from large individual losses. B. It spreads risk proportionally across all policies. C. It reduces exposure to catastrophic events. D. It allows the reinsurer to cover only high-risk policies. Answer B. It spreads risk proportionally across all policies. Explanation: quota share reinsurance spreads risk proportionally across all policies included in the agreement. The ceding insurer and the reinsurer share both premiums and losses according to a fixed percentage. This approach helps the ceding insurer manage its overall risk exposure. Question 28. What is the primary goal of a reinsurance treaty? A. To ensure that individual risks are transferred on a case-by-case basis. B. To establish automatic coverage for specific classes of business. C. To cover all claims resulting from catastrophic losses. D. To define the specific terms of facultative reinsurance agreements. Answer B. To establish automatic coverage for specific classes of business. Explanation: reinsurance treaties are designed to establish automatic coverage for specific classes of business, usually covering large portfolios of policies. They help streamline the process of risk transfer, providing broader coverage than facultative reinsurance, which requires individual risk assessment. Question 29. Which of the following best describes a stop-loss reinsurance agreement? It covers all losses above a certain retention limit regardless of frequency. B. It reimburses the ceding insurer for losses once total claims exceed a predetermined threshold. C. It covers losses from individual high-risk policies on a case-by-case basis. D. It offers coverage for small, frequent claims. Answer B. It reimburses the ceding insurer for losses once total claims exceed a predetermined threshold. Explanation: a stop-loss reinsurance agreement is designed to protect the ceding insurer when total claims for a specific period exceed a predetermined threshold. This type of reinsurance is often used to limit the ceding insurer's overall loss exposure from high-frequency claims, while also providing coverage for aggregate losses. Question 30. What is the typical purpose of reinsurance when an insurer faces an unusually high concentration of risk? A. To increase the insurer's market share. B. To reduce the insurer's capital requirements. C. To mitigate the impact of large, concentrated risk exposure. D. To increase the insurer's profits by taking on more risks. Answer C. To mitigate the impact of a large, concentrated risk exposure. Explanation: reinsurance is typically used to mitigate the impact of large, concentrated risks. When an insurer has a high concentration of risk, for example from insuring many policies in the same geographic area or industry, reinsurance can help spread that risk, reducing the potential financial strain from a single catastrophic event or a concentrated loss.